Welcome everyone to the New Dentist Committee's webinar on the One Big Beautiful Bill Act. I'm going to introduce Heather Relation. She is the NYSDA Director of Membership Outreach and Engagement. She is your go-to resource for any questions that you may have with membership. She serves in many roles in many capacities, and she's going to get our presentation going.
Thank you, Dr. Evan Conley. Like he said, I'm the NYSDA membership concierge, and like you said, I wear many hats. NYSDA membership concierge and the Director of Membership Outreach and Engagement. I just wanted to give you a quick overview of what NYSDA offers you as a member. I know a lot of you are resident members. We're here for you throughout every stage of your career. We're a tripartite membership with the American Dental Association, which you might be more familiar with, and you have a state and local dental society wherever you happen to go in the United States following your residency program. We offer our members at the state level advocacy, legal resources, discounted continuing education courses for your license renewal, and we have exclusive member benefit discounts, including webinars like this, which is actually free for you, even free for new dentists as well. It's geared towards helping you enhance your career and guide you throughout your career. We're here for every stage, so when you graduate, you let us know where you're going, and we can provide you resources all along the way. I do one-on-one member benefit review sessions, so if you wanted to schedule one of those, I'm going to put my email in the chat, so if you wanted to do something like that, we can set that up. But I'm going to pass it back to Dr. Conley. Again, this is a New Dentist Committee presentation, and it's part of our New Dentist Survival Guide series that we continue to add to, and that's on our website as well. And I'll put that in the chat as well.
Thank you, Heather. So tonight we have a very special speaker. We have Sarah Johnston, who is going to present on behalf of Laurel Road. Sarah leads the West Coast Business Development Team, and she's been with Laurel Road and GradFin for the past 7 years. As one of Laurel Road's subject matter experts on student loans, Sarah frequently presents on the evolving student loan landscape and its impact on borrowers' repayment strategies. Her favorite aspect of her role is helping out individuals and helping them to meet their financial goals by developing and optimizing personalized student loan repayment strategies, which is especially important in this current student loan landscape. But without further ado, we have Sarah Johnston.
Thanks, Evan. Thanks for the intro. Like Evan said, my name is Sarah Johnston. I'm with Laurel Road and GradFin, and I'll be presenting this evening. I probably have around 30 minutes of content, so we won't go the full hour, but we'll certainly have time for a lot of questions if you guys have them. Throughout, if you guys do have questions, there is a Q&A section of the webinar, so feel free to put them in. And Amelia on my team, she's on as well, and she'll be able to answer those as we go. But tonight's topic is the One Big Beautiful Bill Act and how that pertains to your student loans. And on the agenda, let's see here, we're going to discuss who Laurel Road is and how we're assisting in the student loan space. I'll dive into the One Big Beautiful Bill Act and what that means for the current legislation surrounding student loans. And then I'll get into the different types of student loans. I like to call it like the ABCs of student loans. There's a lot of different repayment options out there. There's federal loans, there's private loans, there's repayment options on each side. Some of you may be on an income-driven plan pursuing forgiveness. So we'll dive into all of that. And then, like I said, we'll have time for questions at the end, but if you guys do have anything throughout, just feel free to throw that in the Q&A section. But some background about Laurel Road. So we're a financial wellness institution, really just revolutionizing the way student loan borrowers address their student loans. Our primary focus is in the healthcare concentration. So we have around 70% of our business is specifically working with doctors and dentists. And over the past 10 years that we've been in business, we've helped around 30,000 healthcare members, and we've gained partnerships with around 80 plus partnerships with certain healthcare organizations. And our #1 goal is to simplify the complexities of student loans, especially over the past few years. Since I would say COVID, there's been a ton of student loan changes coming out. Every month there's a new change coming out. So even for us in the industry, it's super hard to keep up with. So as the borrower, it's very hard to keep up with everything coming out. So our #1 goal is just to simplify those complexities there. And we do that through a complimentary consultation call where we really dive into your specific financial plan, your student loan picture, and we're going to help everything student loan related. So whether that's originating a student loan on the front end of things or discussing repayment options once you graduate and you're entering repayment, and now we have to discuss your different federal options, your private options. So we can educate on all your different federal options. And then with refinancing, we're a lender and we actually have a marketplace of other lenders as well. So we're a broker and we can help with refinancing in regards to that. We are a part of the Key Bank network. So if you guys ever needed other financial products as well, always reach out and Key can help you with that as well. And ADA is a partner of ours. So I'll dive into like discounts and things like that, but we are a formal partner. So like I mentioned, our bread and butter are complimentary consultation calls. So if you're sitting on the call right now and you have some sort of student loans and you're really just unsure what your options are, or really what pertains to your specific student loans, we coordinate complimentary consultation calls. So I say consultation call, we actually do it over a Teams meeting link like this. So our team has to join via video. You certainly can dial in if you want to, but I think it makes it more personal just being over a Teams link. And it's sort of like a cost analysis or education session. There's no hard transaction. So we're not hard pulling credit. We're not charging anything for this call. We ultimately want you to come in with some sort of goal in mind. So we'll get your goals, we'll get some background information from you. And really what we're going to do next is break down everything that you have going on with your student loans. Like I mentioned, there are 2 different types. There's federal and private. So some of you may have a combination of both. Some of you may just have federal. Some of you may just have private. But if you have federal loans, we'll always start with those repayment options first, because refinancing a federal loan, it's not going to make sense for everyone's situation. Sometimes it might, but sometimes it won't make sense. And so you have more protections too with federal loans. There's more deferment, forbearance protections, more repayment plans, like income-driven plans, forgiveness programs. So it gets pretty confusing. So that's why we always start covering your federal options first. If you're someone with private student loans, really all you can do with private loans is refinance. So that's where we act as a broker. And we're actually our own lender to it, Laurel Road, but we have a marketplace of other lenders if our rates don't come back the lowest. So essentially, we'll shop you around these lenders where you're going to receive the most competitive interest rate. If you're interested in setting up a complimentary consultation call, there's a QR code on the screen. And if you scan that, that will take you to a landing page where you can set up a call. I will let everyone know that we will ask for loan information before we schedule. So that's really important to the conversation because we need to know what we're discussing on the call. And like I mentioned too, we are a part of the Key Bank network. So we're a bank, we have a ton of compliance. So we also have a consent form that we use to verify identity on the call and all that fun stuff. If you're unsure of what loans you have, a good starting point is going to studentaid.gov. So that houses all of your federal loan information. So no matter your federal servicer, you can always go to studentaid.gov, and it's a federal website. So if you don't have an account, you can create one through your social. And then what we're going to be looking for on studentaid.gov is your student aid text file. It's a crazy text file. It looks confusing. There's a bunch of letters and numbers on there. But once you populate that into the GradFin and Laurel Road system, everything populates pretty nicely. And then also, like I said, it does like a consent form just so we can use it to verify identity on the call. And everything else on the call is pretty straightforward. Where you went to school, highest level of education, income, employment history, and things like that. So nothing out of the ordinary. And we'll also send around follow-up information too with how you can schedule. So don't feel like you need to scan that QR code right now. But like I mentioned, there are two different types of student loans. So there's federal and private. And with federal student loans, these loans are funded by the federal government. So one of the few ways you can get a federal student loan is by filling out the FAFSA form. So let's say you fill out FAFSA, and hypothetically, in a perfect world, your tuition is, let's say, $20,000. And you fill out FAFSA and you get $5,000 of, let's say, like your unsubsidized loans, your subsidized loans, and now you have a gap of $15,000 to fund. You can fund that by more federal loans, like a Parent Plus loan, for instance, which is a federal loan tied to the parent. So technically speaking, the loan's in the parent's name, so it's the parent's responsibility to pay back that loan. That doesn't work for every family situation. Not every parent wants to take on that debt for their child's education. So if that doesn't work for your situation, you can also look at a Grad Plus loan, which I would imagine a lot of you on the call have. They are federal loans, but only for graduate degrees. So if you're someone pursuing an undergrad program, you can't take out a Grad Plus loan. So if you can't do a Grad Plus or a Parent Plus, then your only other option is to go the private route, which is a non-federal loan made by a bank, a credit union, a state agency, or school. There are a few differences between federal and private. With federal loans, the interest rates are always going to be fixed, meaning that that interest rate cannot change while you're in school or in repayment. With a federal loan too, you can consolidate it and you can refinance it. And I know a lot of people throw around the words consolidating and refinancing interchangeably, and sometimes they do have a similar meaning. But when we're talking about a federal consolidation, the meaning is slightly different. So let's say you're someone with 6 federal loans in your portfolio. You can consolidate all 6 of those federal loans to one federal loan, and it's going to give you a weighted average interest rate of the 6 of the federal loans in your portfolio. So it's not like a refinance where a lender has now bought out your debt and you have a new interest rate, monthly payment, and term. Your loans are still staying on the federal side. So if you're someone that maybe went to an undergrad program, then maybe you worked for a few years and you went back to grad school or medical school, you may have different federal loans at different servicers or different disbursement dates. So sometimes for the ease of mind, it makes sense to consolidate your federal loans. And also sometimes you're recommended to if you're pursuing an income-driven plan. Like I mentioned as well, you can refinance a federal loan, and this may make sense for some of you, but not for everyone. So I would say be cautious with refinancing federal loans, because once you do, the loan then becomes a private loan and you can never get a private loan back to the federal side. But for some individuals, like if you start making too much money and forgiveness just doesn't make sense, it certainly could make sense to refinance federal if the interest rates are good. It just really depends on your specific situation. And with federal loans as well, you have a lot of repayment plans. So today, as it stands, there's a standard 10-year repayment plan, which every single month you're going to have the same monthly payment for 10 years. There's also a standard graduated plan, which is a 10-year plan, but every 2 years your payment increases. And then there's also a graduated repayment, or excuse me, an extended repayment, which is a 25-year repayment. I'll get to this, but this structure is changing because of the One Big Beautiful Bill Act. But those are like your standard repayment plans today. And then there's also income-driven plans, which essentially are just payments based upon your income. With a private loan, the difference here is that the interest rate can be a fixed rate or a variable rate. A variable rate just means that that interest rate can change while you're in repayment. And I would say it's about 50-50 on what I see with private loans. Some private loans are fixed, some are variable. It really just depends how that loan was underwritten. And then with federal loans as well, you have more protections in regards to deferment and forbearances. So a deferment and forbearance just means that your loan payments are postponed. The difference with a deferment is that you're not responsible for the accrued interest, where you would be with a forbearance. And then diving a little bit deeper into the private side of things. So in simple terms, what a private student loan refinance is when a lender just buys out your debt, issues you a new interest rate, monthly payment, and term. There's a few different reasons why someone would choose to refinance a student loan. First being that you can choose your term and rate based off your financial situation and personal strategy. You can also refinance to choose from a fixed or variable rate. So if you're someone with a private variable loan right now, the only way to lock in a fixed rate would be to refinance that again to a fixed rate. Technically speaking, our lenders can offer variable rates, but they're very volatile, that it's really not something we recommend. But if you're adamant on wanting one, sure, we can get you one. And then you can also refinance to lower your interest rate and monthly payment. I would say that's the number one reason why most people choose to refinance. There's some one-off situations where maybe you can't afford your monthly payment and you have to refinance to the longest term, which is a 20-year, and that may yield a slightly higher interest rate but a lower monthly payment. But that's few and far between. I would say most people will refinance to lower interest rate and lower their monthly payment. And then you could also reduce the number of loans in repayment. So let's say it made sense where we could be let's say 6 of your loans in your portfolio. We could refinance all 6 of those loans to one private loan. It doesn't always work that easy. Sometimes we'll have to cherry pick the loans that we can beat and leave out the ones that we cannot beat. And then you can also pay off your debt quicker. So our lenders offer anywhere the lowest term is a 5-year, and then our longest is a 20-year. And some lenders will offer the standard 5, 10, 15, 20. Some will throw in a 7, an 8, a 12. So we have a lot of flexibility since we have a lender and we're a broker too, with just a lot of flexibility in regards to terms. I always tell people though, don't crush yourself picking the 5-year or the 7-year because it looks really favorable and you're going to pay it off quick. Pick the 15-year, pick the 20-year. There's no prepayment penalties with student loans. So if you wanted to pay it off in 5 years or 7 years, let's say you got a bonus from work and you just had that extra income, sure, you can throw it at your loans and you're not penalized there, but you're not obligated to making that larger monthly payment every single month as you would if you did pick that lower term. Something to also keep in mind, our lenders are going to look at various different factors to qualify you for a refinance. So income is very important. Usually we can start getting rates back when the client has around $25,000 in gross annual income. Most lenders will require a cosigner somewhere between like the $36,000 to $42,000 range. You guys aren't going to have an issue with that. Debt to income ratio also factors in. So everything that's going to pull into your credit report is essentially going to pull into your DTI calculation. So your student loan payments, your auto loan payments, your rent, your mortgage, your credit card minimum monthly payments. I know most people don't know this about themselves, so we'll collect this on the call just to make sure that's under the threshold there. And then credit score is definitely highly weighed. So just something to keep in mind if you're still in residency, just keep your credit score in good standing. Usually we can start getting rates back when the client has around like a 650 credit score, and then usually the higher the credit score, the more competitive the interest rate. Some lenders factor in savings. College level of education is very important, so you guys aren't going to have an issue with that. Usually individuals with higher levels of education like yourself, you'll usually get more competitive interest rates. And right now I would roughly say interest rates are between like the 4 to 7% range. I know that's a pretty wide range, but it depends on all of these factors. So it's hard to give like exact estimates without actually setting up a consultation to see what our lenders come back with. But for competitive borrowers, we're seeing more like your 4s and your 5s. And then for your more average borrowers, we're seeing like your 5s to 7s. And then just being a part of the ADA, you guys actually get a discount through Laurel Road as well. So it's a 0.30% rate discount. We'll factor that in. So if another lender comes back more competitive, of course, we'll go with that other lender. But with the discount, if the lowest rate comes back through Laurel Road, we would send you through the Laurel Road process. I don't think I mentioned this either, but there's no cost to refinancing. So it's really unique compared to refinancing other loans. There are no origination fees. There's no closing costs. There's no prepayment penalties. So if you're someone with a private loan, I would look into rates like every 6 months to a year or so just to see if you can lower your interest rate, because truly there's no cost involved whatsoever. We end up getting compensated from the lender on the back end, so we never charge anything for this. So it's not like we're receiving a cut from sending you to one lender as opposed to the other. We make the same across the board. And so I would just say like at least look into rates, because if you can lower that interest rate, you're going to save money and no cost came out of doing it. Public service loan forgiveness. So this tends to be a pretty confusing topic for a lot of people, but I'll try to simplify it. Essentially, to qualify for PSLF, you're going to have to check a few boxes. Most importantly, you're going to have to work for a qualified company, so either a nonprofit or a government entity. So if you're working for a nonprofit hospital system, or if you're working for the VA, I'm trying to think of like what dentists will usually qualify for, usually a little bit less than what doctors will qualify for, but the VA, the military. Those are common ones. So something to look into if that's the career path that you're trying to pursue. So you have to work in that space, and then also you have to have federal loans. Private loans never qualify. You then enroll your federal loans on an income-driven repayment plan, which essentially is a payment that's based upon your income. Each year you're going to have to recertify your income. So if your income changes on a yearly basis, that means your payment can change from year to year as well. But ultimately you want that payment low enough where you're not going to pay off your entire loan balance in 10 years. And then whatever is left at the end of the 10 years, that amount is forgiven tax-free. The only catch to this program is that it was created back in like 07, 08. So for the past 7-ish years that people have been eligible for forgiveness, they've gone to apply for forgiveness, and there's been a very high rejection rate for borrowers actually getting that forgiveness on their own, for a few reasons. Sometimes it's borrower mistakes, and then sometimes it's servicing mistakes. So some borrower mistakes, you have to have federal loans on one of the income-driven plans, or even the standard 10-year plan will count, but you can't have your loans on a graduated repayment or an extended repayment. That technically wouldn't count towards forgiveness. You also have to recertify your income each year. You have to get forms filled out from your employers that you're actually working full-time at a qualified institution. So sometimes people won't get the forms filled out correctly, and that technically wouldn't count towards forgiveness. So you have some borrower mistakes, and then you also have servicing mistakes. So just the past 6-7 years that I've been in the industry, there's been 3 federal servicer changes. It was Fed Loan Servicing, then it was MOHELA, now it's the Department of Education. And honestly, it's because they've done a pretty poor job managing the program. We have a lot of people that think they're further ahead in the program than what the servicers are showing. And sometimes the clients are actually right. They do have more qualified payments. So I don't want to scare anyone about this program, because it really is a great program. But keep in mind, if you are trying to pursue it, you really just need to follow all the rules to actually get that forgiveness at the end of 10 years of service. So that's public service loan forgiveness. But let's say you don't pursue a job in the nonprofit or government realm, you could still get forgiveness through the second forgiveness program, which is income-driven forgiveness. So there's a few differences. With income-driven forgiveness, first off, your employment doesn't matter. You can work for any company, but it is a longer forgiveness term. So public service is a 10-year repayment, whereas income-driven forgiveness is a 20 to 25-year repayment. And then we'll get to this, it's actually extending as long as a 30-year repayment. So definitely a lot longer than PSLF, which is only 10 years. The other difference with income-driven forgiveness is that if you get any forgiveness after the 20 to 30 years, you're going to owe a tax on that forgiven amount, where public service is always a tax-free event. So it's similar in ways to public service loan forgiveness, where you still have to have federal loans enrolled on one of these income-driven repayment plans. So they're all slightly different on how they're calculated and how you file your taxes, whether that's single versus married. They factor in what state you live in, like poverty level, how many kids you have. So it can get confusing here. So if you're someone pursuing an income-driven plan, reach out to our team. We have a dedicated customer care team specifically helping with the income-driven plans and the forgiveness programs. So we're here to really guide you in the right direction of what program makes the most sense for you based off of your specific situation. And sometimes it will make sense to get on one income-driven plan after a certain amount of time. So it gets kind of confusing there. So just reach out, and we're happy to help with that too. And now let's get into the fun new stuff. So the One Big Beautiful Bill Act, in simple terms, what this is, it's essentially a tax act that was passed on the 4th of July. And it's going to affect many government programs over the next 3-4 years, but it's also going to affect student loans in a lot of ways. So essentially how it's going to affect student loans, there's going to be a new repayment plan that they're going to be introducing, which we'll dive into. And then they're going to crack down on funding student loans, so how many student loans you can get to enter school. And then there's just going to be some changes to qualifying for income-driven plans, forgiveness programs, and things like that. So I wanted to visually put this chart on the screen because I know it can get kind of confusing with all the dates over the next 3 years and when certain things are changing. So the first thing that changed was the SAVE plan. And I'm sure some of you on the call may be on the SAVE plan or have heard of it. So I just wanted to give some context of what it is and how it's going to change. So in July of 2023, they introduced SAVE. It's the newest income-driven plan. It replaced the Repay plan. So any of you that were on Repay, they did away with that plan and they replaced it with SAVE, so you can no longer enroll on the Repay plan. And SAVE was a great plan for, I would say, 2 reasons. It was more affordable for a lot of people compared to the other income-driven plans. I would say it was geared towards low-income undergrad borrowers with just how it was supposed to be calculated. But even individuals with advanced degrees and great income, a lot of the times it was more affordable for these individuals as well. And then there was also an interest benefit. So historically with these income-driven plans, if you don't cover your accrued interest based upon your income, your loans will balloon on you. I mean, I've seen horror stories where people took out loans and then years down the road, their balances doubled or tripled on them. And it's because they weren't covering that accrued interest, so their loans were just growing and growing. But under the SAVE plan, that didn't happen. So if you didn't cover your accrued interest, the government would step in and subsidize it so that essentially your balance would never grow greater than when you first started repayment, which was a neat feature because the other income-driven plans didn't have that interest benefit. It was specifically only a SAVE benefit. So everything was going pretty well with this plan for about a year. And then in July of 2024, there was 2 judges in the Midwest that didn't really believe everything the plan entailed, unfortunately. So they blocked it. They put a stay on it. So anyone that's been on SAVE since last July, so what is that, 14, 15 months ago, they've been placed into an administrative forbearance, meaning that you don't have a payment due, interest isn't accruing, but the months on this forbearance, they're not counting towards forgiveness. So it's kind of been like kicking the can down the road. If you didn't want to make a payment, you didn't have to, and interest wasn't accruing. So some people were just happy that they didn't have to pay on their student loans. But then a few months ago, we found out that interest was actually going to start back up again. So on August 1st, interest has now started back on SAVE. So for a lot of people that just were enjoying the time where they didn't have to pay and interest wasn't accruing, this has now been the fire under them to now get off the SAVE onto another income-driven plan where they will have a payment that will count towards forgiveness. So that's kind of the latest there. SAVE is technically still in a forbearance. They just said until late 2025, which we're here now, or early 2026. So as we find further information, we'll update you guys, but technically it's still in a forbearance. So if you want to stay on it, you won't have a payment due until maybe early next year, but interest has started back up there. And then the new things coming out over the next few years. So they're introducing 2 new repayment plans. So if you're a new student loan borrower entering repayment after July 1st of 2026, you're only going to have 2 federal repayment options. It's going to be a revised standard repayment plan from what we see today. It's a modified standard repayment from today, and then there's also a new income-driven plan called the WRAP repayment. So those are your 2 new options if you're entering repayment after next summer. If you're in repayment before next summer, the only income-driven plan that's going to stick around is income-based repayment. They're doing away with all the other ones. And you'll have until the summer of 2028 to get onto income-based repayment. If you do not get on it by that time, then you're automatically going to be enrolled in the WRAP repayment. And then they're also going to put some limits on how many student loans you can get for college, and there are also going to be some changes to Parent Plus loans. Diving a little bit deeper into the new student loan repayment plan starting next summer. So like I mentioned, there's going to be a new standard repayment plan that's simply it's modified from what we see the standard repayment today, and it's going to be based off of how many loans you have, and that's going to equate to a different term. So it's either you're going to be on a 10-year term, a 15-year term, a 20-year term, or a 25-year term. And then there's going to be a new income-driven plan called the WRAP repayment, which essentially is the newest income-driven plan, and it's going to be calculated by taking your adjusted gross income, dividing that by 12, and then subtracting 50% $50 per dependent that you're claiming essentially on your tax return. I know that's kind of wonky, but if you're interested in that plan, just reach out and we can help you calculate that. The WRAP repayment is still going to qualify for both forgiveness programs. So it's still going to qualify for public service loan forgiveness, which is a 10-year term, and it's going to qualify for income-driven forgiveness. But the difference here with income-driven forgiveness, it's extending out the term to a 30-year repayment. The other income-driven plans were either a 20-year repayment or a 25-year repayment. So it's tacking on 5 to 10 years of that repayment. So for some student loan borrowers that maybe previously would get forgiveness after the 20 or 25 years on one of the original income-driven plans, it may not make sense for you with WRAP repayment since it's 5 to 10 years longer. It really just depends on your situation. So with forgiveness, I mean, it factors in your income, your career growth, your loan balance size. So everyone's situation is going to be different with forgiveness. So always just reach out and we'll be able to run the report to see what path is going to make the most sense for you. And then the standard repayment. So like I said, it's going to be based off of how many loans you have. So if your loan balance is $25,000 or less, that's going to equate to a 10-year term. If your loan balance is $25,000 to $50,000, then that's going to equate to a 15-year term. If you have $50,000 to $100,000, that's going to be a 20-year term. And then if you have over $100,000 of federal student loans, the longest term is a 25-year term. And then how it's going to affect new student loans. So if you're someone that's going back to school, still in school, there's going to be some differences starting next summer. So essentially the amounts that you're seeing on the screen are mainly unsubsidized loans. So for undergrad, the first year, you're going to get $9,500. That's going to be the cap. For your second year of unsubsidized loans, you're going to get $10,500. Your third year, $12,500, and that totals $57,000 total of unsubsidized loans. And then for subsidized loans, this isn't on the screen, but for your first year for undergrad, you would get $3,500. Your second year, $4,500. Your third year, $5,500, and that totals out to, I believe it's $23,500 total. So that's for your undergrad. For grad, you only get unsubsidized loans. So the total per year is $20,500, capping out at $100,000. And they're actually doing away with grad plus loans starting next year. So after you take out your unsubsidized loans, if there is a funding gap, then your only other option is to go the private route. For professional degrees, similar to graduate, you get $50,000 of unsubsidized loans per year, total $200,000. And then parent plus loans, so this is a federal loan tied to the parent. They're capping it out at $20,000 per year per child. Overall, per child is $65,000 per year. There used to not be a limit on how many parent plus loans you can get, so this is a new thing starting next summer. And then that's a lot of information to digest. So just some things to consider. A lot of people don't even know where to start with finding their student loans. They don't know if they have a combination of federal or private. So like I mentioned previously, the first thing that you should do is go to studentaid.gov and see if you have federal student loans by creating that account. And then I think that's just like a good starting place. If you have private loans too, we can see your credit report to see if you have additional private loans on there. But that's like the best starting point. And I never think it hurts to set up a consultation just to run the analysis. It is going to be a lot of information for the average client to digest. So I don't think I've mentioned this previously, but after the consultation, you're always going to get a detailed follow-up report of everything discussed on the call. So you can visually see what it would look like if you kept your loans federal, and it would break down the different repayment plans, all the forgiveness projections, the income-driven plans, the tax liability. And then if you have private loans, it breaks down the different terms, the interest rates, monthly payment, total cost, and cost savings. So you never have to commit to anything on this consultation call with Laurel Road. You can always take this back to your tax professional or your financial advisor just to see like what best fits into your financial plan the best that way. today. So if anyone wants to set up this call, I put the QR code on the screen again. But like I said, we'll probably send around follow-up information with this information in there. But I know that's a lot to digest, so we'll open the floor to questions. I think I saw a few trickle in. Any questions?
Yeah, I had a question. I wrote it on the Q&A, but if you want, I could just ask it over here.
Yeah, for sure.
So does postgraduate dental specialty training tuition fall under the professional category in the terms of the new lending that you said they're going to start in July of 2026?
I believe it does. Amelia, correct me if I'm wrong.
Yes, so it will. And I know somebody also asked about the 20,500 limit. That is per year, but yes, so anything like residency, fellowship, postgraduate like dental or any type of work as of now, that is going to count as like that professional graduate student. I will say for anything regarding the recent legislation, they're currently meeting. They've had actually 2 sessions already, and I think there'll be one at the end of the year and then early next year to kind of define a little bit more what all of this means. So there's going to be more details to come with what is a professional student definition, limits with the RAP repayment plan, income based, etc. So there's going to be more updates on like with federal student aid regarding the recent legislation. So make sure you're kind of like staying on top with like notices, and that's what we will do as well too. We'll make sure all of our clients are aware and our partners are aware of kind of any of the official like announcements, legislation changes, etc.
Thank you.
And I know somebody asked as well too, we're waiting for any more. If you don't change your payment plan by that July 2028 date, they will, as of now, with how the recent legislation states, they will automatically move you to the RAP repayment plan. So if you don't apply for the income-based repayment plan, since that is the only one that is going to still be here, the Department of Education will automatically move you. So someone said like save, if you're on revised pay as you earned before, they automatically moved you to save. They're automatically going to move you to the RAP repayment plan. Looks like someone put, if we are finishing residency or dental school this spring and want to be on IBR, when must we enroll to be on it given the changes coming July 1st to 2026? So there's kind of like a grace period, I want to say, where you have until July 1st of 2028. So you really, so people have some time to make the switch to income-based repayment plan, whether recent graduation, currently on a different repayment plan in general. So there is some time to actually apply for income base. The Department of Education has stated that if you're trying to apply for that, so you get closer to that 2028 date, to give the servicers enough processing time. So I know they might say like maybe 3 months. I would definitely give a little bit longer because right now there's processing delays. It's probably not going to change anytime soon. So once when you kind of are done with school, the loans will enter that grace period. To opt out of that grace period, you usually do have to consolidate the loans, or you can apply. And if you don't decide you want to consolidate, and you can apply for a different income-driven repayment plan or income base, the servicers should in theory have that on hold until you get closer to entering repayment. So when it's closer to that 6 month. grace period. Oh, so the question with if you're on save now, will they just get rid of it entirely and move you to wrap? Yes, there is a chance for that. So a lot of clients are 50-50 when we talk to them with they're moving now to a different repayment plan, or they're staying on save until the Department of Education kind of forces their hand to switch to a different plan. Because as Sarah said earlier, they're continuing to extend this forbearance, no end in sight, no decisions made. So you could be moved if, let's say, this goes until like July 1st of 2026 or that 2028 period, they could automatically move you to wrap because that's going to be the next available plan if people do not apply for income base. So there's always that chance that they will automatically move you to a different repayment plan. Yes, if you're currently kind of on save, it is kind of up to you at the end of the day. That's what we have with the consultation to schedule that meeting. We can go through those estimates to see what, because at the end of the day, your monthly payment is going to change. Since you've been on the save repayment plan, your income obviously could potentially have increased. That's the goal. But your monthly payment isn't going to be a $0 payment or a $100 payment. It could be a $300 payment or $1,000. So depending what that monthly payment is based off your income and your family size, that could be when you decide if you want to switch to a different repayment plan at that point too. But in that consultation, we can run those estimates, especially with tax season coming up as well in a couple months. You might want to apply before you file taxes for, what is it, 2026, 25 year. So it's a little different, and depending when you would want to kind of change. Right. So kind of like thanks, Catherine, for answering that with the type of deferment. Do you want to talk out loud to kind of clarify on your deferment forbearance question?
Oh, I was just asking because I have loans and then it's in
Mhm.
forbearance. I just wanted to know, as if you're in a residency, do you qualify for deferment or you're only like your only choices forbearance? I don't know if that
Yes and
makes sense.
no, it does. So yes and no. They so with residency, there used to be it used to be a forbearance. I think it might now be a deferment now, or still might be a forbearance, but they've kind of changed the names over the years of like what it would be to if you would like to be in a deferment or forbearance. Um, if you don't want that to be in and you want to make your payment on your loans, then you just need to kind of call your servicer to request that deferment or forbearance to end. If you're not sure if you're on the correct like deferment or forbearance, because I know if you go to your servicer's website, it literally will just say deferment or forbearance. Give them a call. Some might have like a chat feature, some might have an email feature, or you can also kind of give them a call just to kind of clarify what actual deferment or forbearance that you're on. If it doesn't say anything like residency or anything like on that aspect, you might need to switch to that and to get on the correct one. But calling the servicer and just double checking to see which one you're on. You might have to actually fill out an application to kind of make that switch, but they'll be able to kind of tell you which one you're 100% on.
Okay, thank you.
Of course.
Also, can you, I don't know if you guys would know, can you talk about any federal qualified health centers? I don't know if this is the right chat to ask about or webinar.
What would you like to know about them?
Just like if there's like a list of places that we could apply to, or like how does that work, or like just I guess just information about it.
Yeah, I mean, I can talk about that too. I'm Dr. Katie Rothis. I'm the new dentist trustee for the New York State Dental Association, and I currently work at a federally qualified health center. So um, it's hard right now. I know there were some periods of time where some of the federal sites were not active or turned off, but if you go to Health Resource Service Administration website, they should have a Find a Health Center page. So you can look for health centers by different states and look to see where there are health centers or where you might be interested in going to. And then go to those different individual websites for those health centers. If you're already enrolled in a National Health Service Corps loan repayment program, they have a specific search tool similar to kind of a Zip Recruiter or Indeed, but for health centers specifically, in which they have health centers that are currently looking for positions or have open dental positions. You can search that way as well, but that one you have to be already enrolled in one of their repayment or scholarship or loan repayment programs. But otherwise, you should be able to look for them online by going to HRSA. You can also go to the National Network for Oral Health Access, or NOAA is the acronym. They are a membership organization that specifically is for people, dentists who work in health centers, and they also have a student and resident membership. I believe is either free or very affordable. They have a job board. They also have a listserv where you can just reach out to a lot of different health center directors and speak with people. So those are some different ways that you can find federally qualified health centers, depending on what state you want to look into.
Thank you.
How about just to follow up with that question, can you work, let's say, multiple part-time jobs at these health centers to get full-time status, or does that have to be at one location only?
That I'm not entirely sure. I think typically HRSA prefers it to be one location, full-time status, but I mean, they do have part-time options for loan repayment. It just requires a longer contract. But that would be a question that would best be answered by someone from the National Health Service Corps. They should have I think they have if you go to NHSC, their workforce page, I do believe they have either a phone number or an email address that you can ask that kind of a nuanced question.
Thank you.
It looks like there was another one in the chat. If you took out federal loans for dental school, passing the cap, and then I'm not sure what a PG program is, I apologize, is the only option private loans. So the current cap is going to be effective with the new legislation as of July 1st of 2026. So if you're kind of continuing education in school, or you're still kind of okay, specialty program. Thank you. Sorry about that. Everyone has different acronyms for everything. But if you're it depends when you kind of start. So if you're kind of going through that specialty program kind of now and you need to take out federal student loans before that July 1st, there's kind of a little loophole, so to speak, where they'll kind of have everyone with the new legislation and another grace period aspect, where you have 3 years to kind of finish your program or before you're kind of part of the cap for the limits with your student loans. But if you're starting kind of after July of 2026 or starting July of 26, then yeah, the only option could potentially be private student loans on that aspect because of the loan aspect of things. Now with that cap as well with the loan limitations, it doesn't kind of include any direct plus graduate loans kind of what Sarah had earlier. So there's a little bit kind of a little loophole conversations with that too, but hopefully kind of more to come with what the limits are. As federal student aid and Department of Education is kind of defining that more. Then there's also, you had to follow up with like deferment while you're in deferment and you're kind of doing residency. Can you apply for a repayment plan? Yes, you can, but the servicer might deny it if you're not in repayment within an X time frame. Sometimes I believe it's around like maybe like 60 days. So in a couple months, you would have to be entering repayment sooner. If you aren't, and let's say that deferment's on there for a year or two, and that's same with forbearance too. If you're not going to be entering repayment within a certain time frame, they will deny that repayment plan application. You can request to have the forbearance or deferment cut, so then they can kind of like basically stop it. So then they can apply the repayment plan, but it depends on where you're at in your deferment forbearance type of process with applying for repayment too. Of course.
And we have about 5 minutes left before 8. Does anybody have any other questions they'd like to ask? The floor is still yours. So there's no, question that's apparently, if there's a question that you have, somebody else probably already has it too. So go ahead and ask it. Don't hold back. This is your time. In the meantime, I just want to thank our presenters. Everybody who joined us tonight. It's a really great opportunity to be able to come on something like this and do a Q&A. We can have this recording on our website as well. So if you want to refer back, you'll at least have that resource. And then again, like Sarah said, schedule a one-on-one. I also have student loans, even though I'm 15 years out of college at this point almost. And I actually just signed up for one myself because I have to understand what's going on with mine. So I encourage you to do the same thing. Dr. Katie Roth has put in her email as well. I'm going to send a follow-up email after this is done with all the resources that we put into, thanks Jessica, she just put in the consultation link in the chat. Sign up for that. I'm going to be sending an email after the fact, so you guys will have all the resources that were listed today. And never hesitate to reach out to us at NYSDA as well. But I'll give it a couple more minutes. If you have any questions, go right ahead and ask them.
I will just say student loans are extremely confusing, so please take advantage of this member benefit because they will sit down with you for your own specific needs. I know I did a session like that and it was extremely illuminating and really helpful in kind of guiding me with my, loan repayment journey. So cannot encourage you all enough to take advantage of this one.
And the fact that you get a reduced interest rate, that 0.3%, or what was it? It was 0.30%. Yes. That makes a huge difference in the grand scheme of things, especially if you have a very large loan and just getting that knocked down a little bit extra for your member benefits.
And it looks like we have one more question, and that's a really great question. I think that for myself, not with like student loans, but just anything, is it better to aggressively pay back the loan or kind of stick to the repayment plan as much as possible? So Sarah said it earlier, there's no harm in paying that loan off like sooner. And if you're able to definitely pay more, maybe some months that can help you because then maybe the next month you can't as much. It puts you in a little bit paid ahead aspect. But I appreciate that follow-up question. What if after the 25 years or 30 years, the forgiveness is not a thing anymore? That's a great question that everyone asks when it comes to income-driven and even public service. Income-driven and public service, respectively, they're a law program. It's statute. It was approved by Congress. So those forgiveness options aren't changing. But with public service, no tax liability. Income driven, there is a tax liability. So maybe depending where you're at in that view of those 25 or 30 years, which that consultation, we can give you that information so you have a good idea. It might help with paying for that or even just saving for the tax liability. So instead of paying aggressively on that, you're putting that extra maybe $100 or even $50 to an account for that tax liability timeframe if you're income driven, like I said, public service, tax free for the outstanding interest and principal. So at the end of the day, it's whatever makes sense for you. If you can pay it aggressively, if you're not doing forgiveness and you just want to pay your loan off as soon as possible, then yes, if you can do that, go that route for as long as you can. If you are trying to go towards more that forgiveness route, whether it's public service or income driven, I would kind of stick to that monthly payment. I know seeing that interest accrue is very scary. I understand that because it is. But if you're going towards that forgiveness route, that you kind of want to stick to your tried and true normal monthly payment, and kind of like anything extra that could be for that kind of like tax liability at the end of that time frame for income driven.
And also to piggyback what Amelia says, you really just have to factor in opportunity cost. So if you're paying off your student loans quick, but they have a pretty competitive interest rate, it's probably not the best financially because you can probably get a better return in the market. So speak with your financial advisor. If you don't have a financial advisor, reach out. We can get you connected to one, but I think it would be very beneficial. But I know everyone's different. Like personally, I just wanted to be done with my student loans and didn't really care about that. So we'll factor in your specific goals and whatnot and just personalize that to your specific situation. But also like with forgiveness, what Amelia was saying, like for some individuals at some point in your career, you may start making too much money where forgiveness like wouldn't make sense anymore, and then like a refinance could save you more money. So that's why I think it's important to stay on top of these calculations every single year, because if at a certain point it doesn't make sense, then you want to refinance to lock in a more competitive interest rate, if that makes sense.
Okay. I think that looks like all we have for questions, unless somebody has anything at the end here. But I just want to thank all of our representatives from Laurel Road for being on this. Sarah, Jessica, and Amelia, thank you guys so much for joining us. Dr. Katie Rothas, Dr. Sarah Kahn, and Dr. Evan Conley of the New Dentist Committee. If you guys have any questions, they're new dentist reps. They're more than willing to talk to you. They know better than anybody what it is like to be a new dentist and this landscape. So anything beyond student loans, please reach out to them. They're here for you. I'm here for you on the NYSDA side. Again, my name is Heather Relation, and you can reach out to me at any time, and you'll be getting a follow-up email with some resources as well. So thank you all for taking the time tonight to join us, and any follow-up questions, never hesitate to reach out.